12 things you need to stop doing with your LLCs to save on taxes. Believe it or not, it's just as important to know what not to do as it is to know what to do with your LLCs. And contrary to popular belief, not all real estate income is treated exactly the same way. So today we're going to talk about how to truly save on taxes with your LLCs if you have active real estate income, and specifically what you should stay away from doing if you truly want to save on taxes. What exactly is active income? It's most things that we'll do to earn money in real estate or other businesses. So if we're talking about real estate specifically, common forms are commissions from being a realtor or a broker. We might have property management fee income. We might have income from co-hosting other people's properties or just consulting income. And it's really important for us to understand how we utilize our entities and what we shouldn't do, because doing things wrong could be very, very costly. If you don't have active income from real estate, but you do have rental income from real estate, we have a separate video on 12 things to watch out for in your LLCs with respect to rental income. So make sure to check that out. Generally, when we talk about active income, one of the best legal entity structures is actually an LLC that files taxes as an S corporation. If you earn income through real estate, like commissions or property management fee, not only do you have to pay federal and state income taxes, but you also have to pay self-employment taxes. And this is where we pay into Medicare and Social Security and all that good stuff. Besides federal and state income taxes, we typically pay an additional 15% tax on top of it. And that's why it's really important for us to make sure we're in the right type of legal entity to be able to minimize our taxes. Why is an LLC taxed as an S Corp better than an LLC just as a regular LLC? It's because as an S corporation, we're able to minimize some of our self-employment taxes. Let's say you made $100,000 of net profit by being a realtor. And by net, we mean, income earned from your clients minus all of your business expenses. So if our net profit is $100,000 and I operate as an LLC taxed as a partnership or a single member LLC, what that means is on that whole $100,000, I'm going to pay federal income taxes, state income taxes, as well as self-employment tax. Now, let's say we have the same exact facts. However, my LLC chooses now to file taxes as an S corporation. For example, if we decided in this S corporation, a compensation I'm going to pay myself that's reasonable would be about $30,000. Well, the way that would work is that I would only pay federal, state, and payroll taxes on that $30,000 that I'm paying myself with W-2. The remaining $70,000 I don't have to pay into payroll taxes, and I only have to pay federal and state income taxes. In other words, I just save 15% tax on that $70,000 of profit that was not paid out to me as a W-2. So you can see the more income we generate for net profit, the higher the potential benefit of filing your tax returns as an S corporation rather than the usual LLC. Let's talk about mistakes. The first thing is to not form an S corporation. Here's the thing, it's a technical detail. There's actually no such thing as an S corporation legally. So when you form an entity, you're actually legally going to form an LLC or you're going to file a C corporation. Okay, those are the only two options with respect to forming a legal entity. So what you'll want to do is to legally form an LLC, and the LLC itself can then later choose whether pay taxes as a disregarded entity, a partnership, or as an S corporation. And it's actually really simple to do. Investors are confused a lot to wonder
what do you mean I'm going to form an entity and then later change to another entity, another bank account and all that?
Actually, no, it's very, very simple. Nothing changes with respect to the legal entity name, the tax ID, the banking info, how you operate your business. All that is exactly the same. When we say file taxes as an S corporation, it's simply something that the tax advisor will do or the legal team will do to make an election, which is the statement with the IRS that says, I now want to start filing tax returns as an S corporation. So again, very simple for you. You form an LLC, there's nothing that changes. Depending on your income and your expenses and your overall strategy, your tax team can help you decide when and whether to pay taxes and file returns as a corporation. So don't go out the gate trying to ask an attorney to form an S corporation for you, because that doesn't exist. The best thing to do is form an LLC, because that gives you the most flexibility to then decide later on how that entity entity will actually pay taxes. The other thing to stop doing is turning yourself into an S corporation prematurely. The reason for that is because we don't have to. The IRS allows us additional time to decide whether or not we want to actually be an S corporation. So best practice, what we typically tell clients, especially if it's a first year business, you're not certain what your net profit is going to be. It could be $100,000 after expenses, or it could be $30,000 after expenses, right? If we're unsure what it's going to be yet, a good practice is to leave it as an LLC for tax purposes, because we have all the way until the end of the year or even as early as the following year to make that final decision on whether we should file our return last year as an S corporation or just as a regular LLC. How do we make that determination might be your question. That determination is based on cost benefit. We want to do a cost benefit analysis to figure out how much is it that you're actually going to save by filing as an S corporation versus how much is it going to cost you to actually file as an S corporation. When you file a return as an S corporation, you have to pay your tax person more money because it's a separate tax return. You'll also be required to run payroll, which is another cost. And so what we want to look at is how much are you actually going to save by doing an S corp election? So if by making that election, you're going to save $10,000 in taxes, but it's only going to cost you $3,000 to file the additional tax return, that could make sense, right? But the alternative could be true if your profit in your business is low after all of your expenses. Let's say you bought a business vehicle and you prepaid a bunch of marketing expenses. So if my profit is very low, I could have very little tax savings from being an S corporation. So if I'm going to save $1,000 in taxes, but I have to pay somebody $3,000 to do a tax return for me, that would be a scenario where I probably just want to stay as an LLC for that initial year. And the benefit of the entity designation is you actually can change between years. So let's say it's my first year starting out in my business. I don't have a lot of profit. I can file as an LLC, disregarded entity. And then the following year, when I do have higher profit, I can always then file as an S corporation in that future year too. Lots of flexibility there. Stop forgetting to pay yourself from your S corporation. Let's say you're at a point where you already know that you're going to save a lot in taxes by filing your LLC as an S corporation. The next thing you want to do is make sure that you put yourself on payroll. And again, if this is a new entity, new business, you can wait all the way until the end of the year to run payroll for yourself. This is really important because it's actually a requirement from the IRS that if you're going to be an S corporation, if you have net profit, if you've taken money out of your entity, you need to pay yourself the lowest reasonable compensation, and that has to be done before the end of the year. The next big mistake we want to make sure we stop doing is actually overpaying ourselves, right? Because as an S corporation, one of the benefits is that the money I take out as owner distributions, I don't have to pay self-employment or payroll taxes on. So if my company made $100,000, I paid myself $30,000 of payroll, that $70,000 I can just take out as owner distributions and I don't have to pay payroll taxes on. If you have an S corporation and you are just running all the profits through payroll, that means you're paying payroll taxes on the whole thing. That unwinds all the tax benefits that you had originally planned on doing. And this is a mistake we see all the time too. A good question to ask yourself is, how am I determining my payroll amount? Is it something that I've strategically thought about with my tax advisor, or am I just haphazardly taking money out as I need it? You can always take money out of your entity through distributions. There are no tax implications of it. And so don't think, oh, just because I need $10,000 or $20,000 every month to live off of, that has to be my payroll. If I needed $10,000 to live off of, but my reasonable compensation is only $6,000, then what I want to do is I'll W-2 myself for $6,000, and the rest of that $4,000, I'm just going to take out as owner distributions. And the benefit is that $4,000 that I took out, I don't have to pay that 15% payroll taxes on. The other thing to stop doing is holding your cars in your S corporation. It's a common misconception that people think they have to own their car in their business in order to take tax deductions. You absolutely do not have to do that. And for the most part, unless if your car is 100% business use, if you have any personal use of that car at all, it's generally better to hold title to your car in your personal name. Now, this doesn't mean you're going to lose out on the tax benefits. You can still get all the benefits because your S corporation can reimburse you for all of your out-of-pocket car-related expenses for your business. One of the downsides of holding title to your car in your entity is not only could you have higher financing costs because now it's a business asset, but you also will typically see higher insurance costs as well because now it's a business vehicle. Something to stop doing is having too many S corporations. And we do see this a lot with some of our clients who are serial entrepreneurs. They'll have an S corporation for their property management, they have an S corporation for their realtor activities, and then they get on social media and start earning marketing fees. And here we go with a third S corporation. So although that might seem really amazing from an asset protection perspective, here's the issue when we talk about taxes. If you have different S corporations and they all have profit and you're taking money out of all of them, well, that means you might have to have 3 different payrolls, right? So that could get very costly because now you're going to have 3 different people run payroll for you every single month. When you have different entities running payroll for you, what happens is you'll end up overpaying in payroll taxes because under the eyes of the IRS, there's 3 different employers. So of course, you're just working for 3 different people. You're going to pay the same payroll taxes over and over and over. A better thing to consider is if you are a serial entrepreneur and you have a lot of different S corporations, what you might want to do is have a holding S corporation at the top. So, you have your property management S Corp owned by your holding S Corp. You'll have your commissions S Corp owned by your holding S Corp. And when you consolidate from that manner, then guess what? Everything rolls up to the holding company. Then you can run one payroll at the top, saves you on payroll costs, and helps you really to alleviate a lot of that duplication in overpaying the IRS, but just payroll. Stop paying for your health insurance personally if you have an S corporation. If you have an S corporation, you can have the corporation pay for your health insurance premiums, and that way it becomes a deduction directly on the S corporation's tax return. So this will help you to get some business benefits, having the entity pay for your personal health insurance. When your S corporation pays for your health insurance, it is a direct deduction on the entity's tax return. Don't forget about retirement planning. If you have an S corporation, this means you have active earned income. And when you have earned income, this means you can contribute to retirement accounts. One way we like to talk about it is, would you rather pay the IRS or would you rather pay towards your own retirement? And if we think about it in those terms, of course, we want to pay towards our retirement. When we pay money to the IRS, our return on investment typically is going to be something like 0. Versus when we pay towards our retirement, then we're able to utilize that to grow for us tax deferred until we eventually pull it out at retirement time. So when you're an S corporation owner, what you can do is be able to contribute 2 layers into retirement accounts. Why? Because you are the owner and you are also the employee. So if we're talking about a retirement plan like a 401k as an example, Susie, the employee, can fund into the 401k, and then Susie's S Corp can also make employer contributions as well. And this is where it gets really, really powerful because now we're talking way beyond the $6,000, $7,000 a year we can put into an IRA. We can have 401ks or defined benefit plans where we can stash away $60, $70, $100 or over $100,000 a year into retirement account rather than paying towards the IRS. Don't forget to grow your investment funds as well. As an S Corp owner, we're able to have a 401k. And once you put the money in there, what a lot of people tend to do is ignore money that's in our retirement accounts. The reason why is because we're not able to access it, right? So it kind of just sits there. It withers away in investment fees that the brokers collect all the time. It withers away in account fees. It fluctuates up and down with the stock market. It's really important for us to understand that our retirement money is actually one of our most valuable buckets of resources. Why? Because it's money that's either tax-free or tax-deferred. Instead of having that be a lazy asset that we don't pay attention to, let's make sure we pay attention to that money because that money is something that could grow for us exponentially. And if we put that to work in the right assets, we could see some amazing growth. If you're a real estate investor, why have your 401k or IRA money stuck in the stock market? Why not move it to a self-directed account where we can use that to invest in real estate, in notes, or even in other businesses that maybe we believe will provide us with really great returns? Your S corporation should be used to operate businesses. It should not own assets. This is very, very important because we don't want to hold appreciating assets like real estate in a corporation for 2 reasons. One, your active business is typically going to be the bucket where you have the most risk, right? Whether you're a realtor or a lawyer, if you're selling stuff, that's where all the risk is. And so typically we don't want to have assets in the same bucket where we have risk and exposure. Now, the second piece of it, which is more related to taxes, is that we just don't want to have anything appreciating within our S corporation. And that applies to stocks or business and especially real estate. One of the biggest downsides of holding rental real estate in an S corporation is that if there is debt involved on that property, then my ability to use our rental tax benefits like depreciation and write-offs and things like that could be significantly limited. In other words, even if I'm able to create a bunch of losses, my losses may be trapped inside the S corporation into the future if I have debt right now on my real estate properties. What if you still wanted to use money from your business to buy rental properties? Here's how you do it the right way. Let's say I have an S corporation where I earn my realtor commissions. I've built up $100,000 over the years. Now I want to utilize that money to invest in rental properties. All I have to do is take an owner distribution. So I move money from my S corporation account into my personal bank account. From my personal bank account, now it can go out and buy rental properties in my personal name or in my rental LLC. Simple as that. One thing we have to be very careful of as S corporation owners is not to liquidate the debt. Well, if you have a successful business, what happens a lot is you start getting credits and loans for your business, right? So I have this business I built up, my accounting firm, I've done really well, and now I'm going to go out and get an SBA loan. I'm getting different kinds of loans because I'm showing really good income. What you might think is, well, I have all this money in my S Corp. Maybe I don't need it for my business. I want to utilize that to invest in my rental real estate. So why not just take a distribution and then in my personal name, I'm going to buy rental properties? Well, here's a potential issue. If you take money out of your S Corp beyond your profit, beyond what you initially put in, now you're liquidating money that's in the form of debt. When you're taking out money beyond what you earned and you put in, you may have a big tax issue because now that distribution could become taxable to you. And of course, there are other ways around that, but generally speaking, if your S corporation has debt and you're trying to liquidate that debt out of the S corporation to use for investment and other purposes, make sure you talk with your tax team to do some proactive planning on how to best utilize that money. This might be a little bit controversial, but if you have an S corporation, don't pay your kids. And I don't mean don't pay your kids ever. I just mean maybe don't pay your kids from this entity. When you have kids who are helping out in your real estate business, when you pay them from an LLC or sole proprietorship, if they're age 18 and under, you can actually avoid, or they can actually avoid paying part of payroll taxes into Medicare, Social Security, and things like that. However, if you pay your kids from your S corporation, then they can no longer be exempt from that, regardless of what age they're in. If I have an S corporation business and I have kids who are older, perfectly fine to pay them because they have to pay payroll. I mean, we all have to pay the payroll taxes anyway. But if I have kids who are younger in age and I want them to help out in my real estate, then the better way to do it is to pay them from your other entity. So if I also happen to own rental real estate, I'm going to have my kids help out with my rental properties, with cleaning, with turnovers and things like that, then I want to pay them through my LLC so that I can avoid or help them avoid some of these payroll associated taxes. If you like this video, hit the like button and subscribe for more real estate tax tips.